Good evening, class. You are all welcome to today's class. Last week, we are done with accounting for inventory. Today, we are going to look at costing techniques. Costing techniques. And in this aspect of costing techniques, we'll be looking at two costing techniques. Types of costing techniques. We'll be looking at two types, the marginal costing and the assumption costing techniques. The marginal costing. The marginal cost of an item is its variable cost. Marginal production cost is equal to marginal production cost is equal to direct materials plus direct labor plus direct expenses plus variable productions overheads. This is marginal production cost. That is why you see it says marginal cost of an item is its variable cost. All these costs that are variable cost to the production, they are marginal costs. Variable costs are those costs that vary with the level of activities. As the level of activities increases, variable costs will also increase. And the variable cost per unit of an item is assumed to be constant. The variable cost per unit, if it is 10 naira per unit, is 10 naira. Then when the level of activities increase from, let's say, 1 to 2, the variable cost will now move from 10 to 20 with the level of activities. When the per unit increase, the variable cost will increase according to the per unit increase. So now marginal cost of a sale for a product. The marginal cost of sale for a product is direct materials plus direct labor plus direct expenses plus variable productions overheads. And this example of this variable production overhead is variable selling and distribution cost. Where you have variable selling and distribution cost, that variable selling and distribution cost is also referred to as variable production overhead. Marginal cost of sale for a service. Now, if you are determining the marginal cost for a service, the direct materials plus direct labor plus direct expenses, then plus the variable overheads, that will give you the marginal cost of sales for a service. Then marginal costing and its uses. Marginal costing and its uses. Uses of marginal costing. Marginal costing is an alternative to assumption. It's an alternative assumption costing as a method of costing. In marginal costing, fixed productions overhead are not absorbed. That is one of the major differences between the marginal costing and the assumption costing. In the marginal costing, fixed overheads, productions overhead are not absorbed into production costs. They are not absorbed into production costs. Marginal costing only includes those production costs which change with the number of units produced. So this is telling you that marginal costing only includes variable costs. Unlike the assumption costing takes care of the fixed costs, but marginal costing only considers the variable cost in the production process. Then the uses of marginal costing. The uses of marginal costing. Uses of marginal costing. One, ensure profit or loss as an alternative to absorption costing. You use the marginal costing to determine the profit or loss. And this comes now as an alternative to absorption costing. Then two, forecast. You use marginal costing for forecasting what future profit will be. Use the marginal costing for forecasting what future profit will be. Then three, calculate what minimum sales volume must be in order the minimum sales volume that must be in order to make profit. Then number 4 can also be used to provide management information for decision making. Use marginal costing to provide management with information for decision making. If you use the management costing, you can make a conclusion. And simply telling you the contribution of each of the product towards the coverage of the fixed cost of that company or of that organization. So marginal costing is used for decision making. Then for planning, marginal costing is also used for planning. To plan volume be sell, to plan what contribution earned from each product in order to make profit. And then you also use it for planning and you make a decision whether to produce within your company or to outsource. You can use marginal cost to carry out whether to produce within or to outsource. Then assumption in marginal cost. Assumption in marginal cost. Every additional unit of output or sell, every additional unit of output or sell, or every additional unit of activity has the same variable cost as every other unit. So when you are dealing with units, it's simply telling you that the assumption is that the unit is cost and the unit cost is cost. If you are dealing with every additional unit of an output or sales, or every additional unit of activity has the same variable cost as every other unit. The unit cost is constant. That is one of the assumptions. Then fixed costs are costs that remain the same in total in each period. The fixed cost in total and in each period. So in each period, the fixed cost is the same. The total fixed cost is the same for each period, and it does not change in the period. Then, regardless of how many units are produced and sold, so within that period, regardless of how many units are produced and sold, the cost is cost. That is another assumption of the marginal cost. Then costs are either fixed or variable. Marginal costing, the costs are either classified as fixed cost or variable cost, or a mixture of fixed and variable costs. So you have a mixture of fixed and variable costs. Then number 4, the marginal cost of an item is therefore the extra cost. The marginal cost of an item is the extra cost that will be incurred by making and selling one extra unit of the item. That is the marginal cost. The additional cost you incur for producing an extra unit. Then contribution in marginal costing, it's a key concept in marginal cost. Contribution is a key concept in marginal cost. In marginal costing, you determine contribution. Some of the decision will be around the contribution. So contribution is key in marginal cost. What is contribution? It means sales minus variable cost. That is contribution. If you know yourself and you take away the variable cost, you minus variable cost from sales, what will be left will be contribution. Let's look at this example. This is an example. A company manufactures and sells products A and B. These are the two products, product A and product B. Product A has a variable cost of 6 naira. and sells for 10 naira. And product B has a variable cost of 8 naira and sells for 15 naira. Required calculate contribution per unit. So now using marginal costing to determine the contribution for these two products, A and B. This is how you do it. Let's create another page. So this is it. Let's take our question. Let me copy it here. I take it here so that we don't have to be. Okay. So the requirement here is for us to determine the contribution per unit. And in this case, we have our sales per unit and we have our variable cost per unit. So with this, we can determine our contribution per unit. To get the contribution per unit, sales per unit for product A, product B, naira. Good. So this is it. We have product A and product B. So now our sales per unit or same price per unit. You can say sales per unit, our sales per unit. This is price, sales price. Good. Selling price per unit for A from the question product variable and a sales price of 10 naira. For A, sales price is 10 naira. And for B, sales price is 15 naira. You have 15 naira. Then the variable cost per unit. The variable cost per unit. The variable cost per unit for product A, for product A is 6 naira. Product A is 6 naira. 6 naira. For product B is 8 naira. Product B, 8 naira. So now 10 naira minus 6 naira will give us 4 naira. So whatever we get here now will be the contribution. Because we say contribution is the difference between the selling price and the variable cost. So the 10 naira minus 6 naira will give us 4 naira. So for product A, the contribution of product A is 4 naira. Then for product B, we have 15 naira minus 8 naira. 15 minus 8 will give us 7. So for B, contribution for product B is 7 naira. So this is how to determine contribution. This is the contribution for the two products. This is the contribution. So the total contribution from the two products will be 11 naira. 7 plus 11 plus 7. So the total contribution from the product will be 11 naira. if you say total, this is the total. So the total contribution will be 11 naira. If you have 25, 10 plus 15, 25, 6 plus 8, 14. So the total contribution from the two products will be 11 naira. So this is this. Good. All these are in naira. So 11 naira will be the total contribution of the two products. The total contribution for the two products is 11 naira. Product A contributes 4 naira. Product B contributes 7 naira. Okay, so this is about contribution. This is contribution. Then the next thing, reporting profit with marginal costing. How do we report profit with marginal costing? How do we report profit with marginal costing? That's the next thing we'll be looking at. Reporting profit with marginal costing. Profit is measured by comparing revenue with cost of goods sold in the period. The revenue generated in the period, you compare it to the cost of goods sold in that period. And then you deduct all expenses. You deduct expenses. That will give you the profit. That is how you report profit in marginal cost. The goods sold. The goods sold is the total cost of cost production. The goods sold is the total cost of cost production in the period, adjusted for inventory movement. Adjusted for inventory movement. Do you have opening inventory? Do you have closing inventory? You make this adjustment. Then in a marginal costing, the opening and closing inventories are measured at their marginal cost. So you see, the inventory now, you measure the inventory at their marginal cost, whether opening or closing inventory. You measure them at their marginal cost. The cost per unit includes only the variable cost. The cost per unit includes only the variable cost. Is that okay? The cost per unit includes only the variable cost of production. Only the variable cost of production. You know variable cost? And these are examples of the variable cost. The cost per unit includes only the variable cost of the production. And these are examples of the variable cost. Direct materials. All direct costs. Direct materials, direct labor, direct materials, direct labor, direct expenses, and variable overhead. And variable overhead. No fixed cost. Then when measuring profit, when you are measuring profit now using marginal costing, it is usual to identify. Same way we determine contribution. This is how you also determine contribution scenario. And then to subtract fixed costs. If you determine your contribution, you now remove fixed costs from the total contribution in order to get profit. So when you determine your contribution, the next thing you will do is to remove fixed costs from the contribution, and the remaining balance will be your profit or loss. If contribution is more than the fixed cost, then you will be reporting profits. And in a situation whereby the fixed cost is more than the contribution, you will be reporting loss. The contribution was unable to cover the fixed cost. And in a situation whereby the contribution equals the fixed cost, at that point, you recover all your costs. It is a point of break even. You recover all your costs, but you will not be making profit. At that point, you recover all your costs, but no profits. So let's look at this. Fixed costs are constant in each period. Fixed costs, they are constant in each period. To make profit, an entity must first make enough contribution. For an entity to make profit, it must first make enough contribution that will cover its fixed costs. To cover its fixed costs. Contributions towards covering fixed costs, contribution towards covering fixed costs and making a profit. If you make enough contributions that cover your fixed costs, what will remain will be the profit. Then now, to determine profits, you will not say total contribution minus fixed cost. Total contribution less fixed cost. If you take total contribution and less fixed cost, what you have will be profit. What you have will be profit. So the difference between and fixed cost will give you profit. And the difference between and variable cost will give you contribution. So this is another question. This is another example. This is another example. A company manufactures and sells two products, product A and product B. Product A has a variable cost of 6 naira. Product A has a variable cost of 6 naira. And product B has a variable cost of 8 naira. Product A sells for 10 naira. The selling price for product A is 10 naira. And for product B, sells for 15 naira. The selling price for product B is 15 naira. During the period, 20,000 units of product A and 30,000 units of product B were sold. During the period, 20,000 units of product A and 30,000 units of product B were sold. So this is the quantity sold for product A, 20,000 units, for product B, 30,000 units. Fixed cost were 260,000. The fixed cost is 260,000. What was the profit or loss for the period? So now we're going to determine the profit or loss from this. The first thing you will do, let's take the question. So that we don't have to be moving back and forth. Let's take the question. So this is question 2. This one we can say one. This one is 2. So this example 1 and example 2. So now let's see. Example 2. A company product A has a variable cost of product B has a variable cost of 8 naira and sells for 15 naira. During the period, 30,000 units of product A and 30,000 units of product B were sold. Fixed costs were 260,000. This is the total profit or loss for the period. So now the first thing we will do, we have product A and product B. And all these are in Naira currency. In Naira currency. In Naira currency. Okay. We have sales, selling price. We have selling price. Let's deal with in per units. And then let's have another product A and B, the same A and B. Now let's have this in total. Good. Because we need the total in solving this. So now for the A, B, so the quantity is 20,000 units, and for B is 30,000 units. We have 20,000 units for A, and then B, we have 30,000 units. And then the total for the A and B now. Good. So this one now will give us a per unit. We'll determine it per unit, and we'll also determine based on the quantity sold. We'll determine per unit and we'll determine the quantity sold. So for the per unit, the selling price per unit, for the per unit, the selling price of product A is 10 naira, and for product B is 15 naira. And then the variable cost, the variable cost for product A is 6 naira. Product A, 6 naira. For product B, is 8 naira. Product B is 8 naira. Then the selling price for 20,000 units of product A, the selling price for 20,000 units of product A, we will say 20,000 times 10. The price per unit is 10 naira. So 20,000 units were sold. So 10 times 20,000, we will have 200,000 naira. So this is the selling price for the 20,000 units. Then for B, 30,000 units were sold at 15 naira per unit. So to get the sales price for 30,000 units, we'll get 15 naira times the 30,000 units, which will give us 450,000 naira. So this is the sales. Then for the variable cost, the variable cost for A is 6 naira. The variable cost for A is 6 naira. And we have 20,000 units. So 120,000 naira. This is the variable cost for product A. Then the variable cost for product B, the variable cost for product B will have 8 naira variable cost per unit. multiplied by the 30,000 units sold. So 8 times 30,000, we have 240,000. So the next thing now will be our contribution. So the next thing now will be our contribution. So now our total, to determine our total, the total sales, the revenue that will be generated from sales, total revenue will be 200 plus 450,000, which will give us 650,000. So this is the total revenue or total sales for product A and B. That 20,000 and 30,000 units. This is what will be realized. Then the variable cost will be then the variable cost will be 220,000 plus 240,000. So the variable cost will be 360,000. This is the variable cost. So this is the variable cost. The next thing now will determine the contribution. This is the contribution. So the contribution per unit is the 10 naira minus the 6 naira, which is 4 naira. This will be contribution per unit for product A. The contribution per unit for product B is 15 naira minus 8 naira, which is 7 naira. This is the contribution per unit for product A and for product B. Then next is the contribution for the 20,000 units sold of A. The contribution for the 20,000 units sold of A, the contribution will be the 200,000 minus 120,000, which is 80,000. So product A in total will contribute 80,000. When you sell 20,000 units of product A at 10 naira with a variable cost of 6 naira, you will be contributing 80,000. So this is the contribution, total contribution of product A. Then B now, the 450,000 minus the 240,000. We will have 210,000. 450 minus 240 will give us 210,000. This is the contribution of product B. So by the time we add this and this, it should be able to give us, when we say this minus this. So now let's minus it and see. 350,000 minus 360. 650,000 minus 360,000 will give us 290,000. 290,000. And remember, we are working with the total 290,000. Now we want to determine the profit. Now we know the contribution. The contribution per unit for product A and B, we know for A to be 4 naira, for B to be 7 naira. And when the A is sold, the contribution will be 80,000 naira. And when 30,000 units of B is sold, the total contribution will be 210,000. So now to determine the profit from this, our total contribution for A and B is 290,000. That is the total contribution, 290,000. So to now get the profit, you now say fixed cost. You now remove the fixed cost from the our fixed cost. Fixed cost of, look at the fixed cost here. Is that fixed cost of 200,000? Then what was the profit or loss? Profit or loss? So if we remove the 260,000 here, what is remaining will be the profit or loss. The contribution is higher than the fixed cost, we are making profit. If the fixed cost is higher than the contribution, we are making loss. Sorry. This is fixed cost. This is a fixed cost. So the next thing to determine now, what we'll be getting now will either be profit or loss. Profit or loss. So now we have 290,000. 290,000 minus 260,000. 290 minus 260 will be left with 30,000. So this 30,000 is our profit. The 30,000 is our profit. So this is how we determine profit from the marginal costing. So this is our profit. Our profit is 30,000. Hope this is clear. It's direct. So next is another example that we'll be looking at on the same marginal costing. This is another example. Mukordi Manufacturing makes and sells a single product. Selling price per unit is 150. Variable costs. These are the list of the variable costs. Direct material per unit at 35 naira. Direct labor per unit at 25 naira. Variable overhead per unit at 10 naira. Then marginal cost per unit used in inventory valuation. The marginal cost per unit that is used in inventory valuation, 70 naira. $25 plus 20 plus 10 will give you 70. So this is the total cost, total variable cost. And it is the total variable cost you use in your inventory valuation. That is what this means. Your total variable cost is what you will use in your inventory valuation. It says budgeted fixed production overhead. The budgeted fixed production overhead is 110 naira per month. 110 naira per month. Then The following actual data relates to July. The following data relates to July and August. July, fixed production cost 110,000. Production 2,000 units. Sales 1,500 units. The August, fixed production cost 110,000 is fixed. Production 2,500 units in August. Sales 3,000 units in August. So to will calculate the contribution and the profit. This example number 3. So now, the first thing we work out here is the sales. The sales, July and August. We are going to determine the marginal cost profit statement. That is what we are to prepare. Marginal cost profit statement. That is what we are preparing. Marginal cost profit statement. Okay. So now the first thing is the sales. That always come first. We have the sales. And the sales is for 2 months. We have July and August sales. July and then we have August. Correct. Let's have the nearer side. We have sales. The sales, we have the sales for July. The sales for July, 1,500 units was sold in July, and 3,000 units was sold in August. So the sales, we have 1,500. At what price? 1,500 units. At what price? We have the price per unit. We are giving the price to be 150 naira. Selling price per unit, 150 naira. So selling price is 150 naira. So for July, was sold in July at 150 naira. 150 naira. So 1,500 multiplied by 150 naira. 1,500 times 150 will give us 225,000. 225,000 for July. Then for August, 3,000 units was sold at the same 150 naira. So 3,000 times 150 naira. 3,000 times 150 naira will give us 450,000. Then the next thing, we are going to look at is our opening inventory. Do we have opening inventory? Do we have opening inventory? From the records will determine. For July, we are not given any opening inventory for July. For July, no opening inventory. Then the total production for July is 2,000 units. And out of this 2,000 units in July, 1,500 was sold. 1,500 were sold. So we'll be left with 700. So our opening inventory to determine it is equal to the 2,000 units produced less the sales of 1,500. It will have 500 units. That is the unit. This is the opening inventory, 500 units. And this 500 unit is at what cost? To get the value, the 500 unit is at what cost? We said we value inventory in marginal costing. At what value? At the marginal cost per unit. This is the total variable cost. And our total variable cost here is 70 naira. 70 naira. So it used inventory valuation. So we use this to value our inventory. So times 70. 500 times 70 will give us 35,000. So this will be our opening stock in August. This will be our opening stock in August. So now we have opening inventory or opening stock or opening inventory. So our opening inventory is equal to, for July, we do not have any opening inventory. Then for the August, the 35,000 that we've determined is our opening inventory. So the next thing that will follow now is our variable production cost. Our variable production cost will be the next one. So let's talk about production cost. Variable production or variable cost. Variable production costs. This is the variable production cost. Let's see them as arranged here. So we have direct labor at 35 naira. We have direct labor at 35 naira. We have direct labor and the direct labor, the quantity produced in July, the quantity produced in July is 2,000 units of produced in July. 2,000 units produced in July. So we have 2,000 units multiplied by the variable cost per unit, which is 35 naira. 35 naira. And this will give us 200 times 35. 200, 2,000, sorry, 2,000 unit times 35 naira will give us 70,000 naira. So we have 70,000 naira here. Then the next item, the next variable cost after the direct labor is the variable production. Sorry, there is material. Is direct material first before direct labor. Direct material is the 35. Sorry, this is direct material, not direct labor. Direct material. Then the next is direct labor. For the same 2,000 that is being produced in July at the price of the variable cost per unit for direct labor, variable cost per unit direct labor is 25 naira. So 25 naira for the 2,000 produced in July. 25 naira will give us 2,000 times 25. 2,000 times 25 naira will give us 50,000. Then the next variable cost is variable production overhead, which is 10 naira per unit. Variable production overhead. Variable production overhead. Variable production overhead for the 2,000 units is at 10 naira per unit. 10 naira per unit. And this will give us 2,000 times 10. 2,000 times 10. 2,000 unit times 10 naira will give us 20,000 naira. This is the total variable cost for product for the month of July. For the month of July. Let's also determine that for August. Let's determine that for the month of August. For the month of August, the direct material let's see the unit produced in August. The unit produced in August In August, we have 2,500 units produced. 2,500 units produced in August. So 2,500. 500 units at the same 35 per unit. The direct materials at the same 35 naira per unit. 35 naira. So 2,500 times 35 naira. 2,500 unit times 35 naira will give us 87 naira. Sorry, 87,500. 87,500. Then the next is direct labor. Next, we have direct labor. The direct labor for the same 2,500 units produced at the direct labor is at 25 naira per unit. 25 naira per unit. So the 2,500 times 25. 2,500 times 25 will give us 62,500. Then the next thing is the variable production overhead. Production overhead. For the 2,500 units at 10 naira per unit, which will give us 25,000. So now, for this, we have closing inventory for July because we produced 2,000 and we sold 1,500. So that means there is closing inventory for July. There is closing inventory for July. We produced 2,000, we sold 1,500. So now the closing inventory for July is our opening inventory for August, which we determine at 500 units at the price of 70 naira per unit. Which is 35,000. So this is our closing inventory. Let me have it here so that you understand it clearly. Let's bring the working here. The opening inventory is the 500 units, which is sold at 17 naira. Valued at 17 naira. So this is it. So our opening inventory for August is our closing inventory of July. So now, for August, do we have closing inventory for August? Let's see. For August, the total production for August is 2,500. And remember, we have the 500 from July. That will make it 3,000. And total sales for August is 3,000. That means there's no closing inventory. That means there's no closing inventory. We have an opening stock of 500 units and we produce 2,500 units. That will make it 3,000 units. And we sold 3,000 units in August. That means there's no closing inventory in August. So the closing inventory in August is nil. No closing inventory in August. So now to determine our cost of sales. To determine our cost of sales. And this will be the sum of this 70,000 to 35,000. So the sum of this will give us our cost of sales. So 70,000 plus 50,000. Let's add it and see. 70 plus 50 plus 20 plus 35. That will give us, sorry, 70 plus 50 plus 20. This is a closing inventory. We are removing it from here. This is closing inventory. It's not part of the cost. Good. Good. So now we have, it's okay. So now we have 70,000 plus 50 plus 20. That will give us 140 minus 35. Minus 35,000. So our cost of sales will be 105,000. This is for this. Our cost of sales will be 105,000 for the month of July. Then for August, so for August, we have the total cost, 35,000 plus 87,500 plus 62,500 plus 25,000. That will give us 210,000. 210,000. So this 210,000 is our cost of sales. So now to determine the profit from this, we determine our contribution. The contribution from this now, contribution. So the contribution will be this total cost of sales. We have our total sales. So total sales minus total cost of sales. Our total sales here for July is 225,000. 225,000 minus our cost of sales. Our cost of sales is 105,000. We will have 120,000 as our contribution for the month of July. Then same applies to the month of August. Our total sales for month of August is 450,000. And our cost of sales for the month of August is 210,000. So 450 minus 210, we will have 240,000. This is our contribution. So to determine our profit now, the next thing is our fixed cost. fixed cost, fixed production cost, which is 110,000 for July and 110,000 for August. Look at it here. Fixed production cost for July, 110,000. For August, 110,000. Its fixed cost does not change. So we come back here, we said 110,000. And here we also have 110,000. And this is a cost. So we are deducting it. We'll have it like this. So the profit or loss now from this, profit or loss now will come from the contribution minus the fixed cost. The contribution minus the fixed cost will give us the profit or loss. So 120,000 minus 110,000. This will give us 10,000. So the contribution for the month of July is 10,000. 240,000 minus 110,000 will give us 130,000. So this is the contribution for the month of August. So this is how to present a statement of profits using costing. Marginal costing profit statement. This is how it appears. I hope this is clear. So this is marginal costing. This is how you present a profit statement using marginal costing. Do not forget that your inventory is valued as marginal cost, which is your total variable cost. So I hope this is clear. So the next thing we are going to look at advantages of marginal costing. What are the advantages of marginal costing? One of the advantages, it is easy to account for fixed overhead using marginal costing. It is easy to account for fixed overhead using marginal costing. They are treated as period costs and written off in full as an expenses in the income statement. Just like what we did here. Look at the fixed overhead. Look at it here. We expense it. We account for it here and expense it for the period, for each period. For September, we expend it. For August, we expend it. Then number two, there is no under or over assumptions of overhead with marginal costing. If you are using marginal costing, there is no under or over assumption. So in marginal costing, there is no under or over assumption of overhead. With marginal costing, no need for adjustment in the income statement. So you don't make any adjustment regarding overhead assumption or under assumption in marginal costing. Then marginal costing provides useful information for decision making. Marginal costing provides useful information for decision making. It gives you the contribution of each product. Then contribution per unit is constant. Contribution per unit is constant, unlike profit per unit, which varies as the volumes of activities varies. So contribution per unit is constant, not like the profit unit, which varies as the volume of activity varies. Then disadvantages of marginal costing. Disadvantages of marginal cost. One, marginal costing does not value inventory in accordance with the requirement of financial reporting. You see, if you look at it, the inventory, we value it here at marginal cost, which is the total variable cost. And this is not the requirement of financial reporting. Inventories in financial reporting are not measured in marginal cost. Then B, marginal costing can be used to measure the contribution per unit of product or the total contribution earned by a product. But it is not sufficient. That's one of the advantages. Measuring the contribution per unit or total contribution earned per product is not sufficient to decide whether the product is making profit or not. Just getting contribution per unit or total contribution does not decide. It does not give enough information whether the product is making profit or not. So this is it about marginal costing, the costing technique. So the next costing technique we will be looking at is the absorption costing. The absorption costing. Reporting profit with absorption costing. Absorption costing is the traditional way of measuring profit in a manufacturing company. The traditional way of measuring profit in a manufacturing company. Inventory is valued at the full cost of production. Inventory is valued at the full cost of production, which consists of direct materials, direct labor, direct cost plus absorption productions overhead. When we come to the absorption costing, that is where we will be considering under and over absorption of overhead. Fixed and variable productions overheads. Then fixed production overhead may be under or over absorbed because the absorption rate is a predetermined rate. So in our next class, we'll be looking at the absorption costing. We are done with marginal costing. Now, next class, we'll be looking at the absorption costing. And that will end the costing techniques, and we'll move to another different topic.